Well, President Trump's battle with Fed Chair Jay Powell taking another turn this week, or another leg down, I suppose. Those attacks coming as the Wall Street Journal reported this week that the president may announce Powell's replacement by early this fall. The White House yesterday denying that the president is close to announcing Powell's successor. And joining us right now is former Federal Reserve Governor Daniel Tarullo. He led the central bank's regulatory reforms in the wake of the financial crisis. He's now a Harvard law professor. And, Dan, we've got a lot to talk through. I guess we could take this as our opening discussion, though. What do you think about the attacks against Jay Powell? Does it impact the Fed? And how does the Fed react, if anything?
Well, the attacks have sort of become the norm now, Becky, I think, rather than unusual. I genuinely believe that Jay Powell is trying to do two things in the last year of his term. One is to make monetary policy calls as he thinks the analytics and the economy warrant. And two, and closely connected to that, is to try to preserve the Fed's monetary policy independence. As I think you saw in his press conference, I don't think he's being pushed in a direction towards more accommodation in an effort to relieve any pressure on himself. I think he's been willing to take a lot of pressure.
All right, let's shift gears, I suppose, and ask what you think the Fed should be doing right now, what you'd be doing if you were a governor. We just got these new numbers that were a little confusing just in terms of what consumers are feeling, both in terms of what they're spending and in terms of what they're saving and bringing in. Where do you think the economy is right now? Would you cut rates at this point?
Not at this point. I wouldn't. I think, as you have a couple of segments already this morning, Becky, I think, which shows that uncertainty kind of abounds. The speculation about how much impact tariffs are going to have and on inflation, and more importantly, probably than that, how long lasting that impact will be, whether it will work its way into secondary price increases. There's a lot of uncertainty, obviously, around that. Neil Kashkari was addressing that this morning, I think. On the consumer side, we not only have the softer income numbers and the questions about whether or not there's going to be a reduction in consumer sentiment translating into reduced consumer activity. So you've got an unusual situation in which there are pressures on both sides of the mandate. But to this point, both sides of the mandate are performing reasonably well. And so I think under those circumstances, Chair Powell and the rest of the FOMC are well advised to wait to see if they can identify more of a dominant trend before they act. Now, look, the Fed should always try to be ahead rather than purely reactive. But I think now is a time when it's particularly difficult to be in that position.
The Federal Reserve voted this week to ease some of the bank leverage rules, the SLR. You've been a fan of that, but I think with some caveats. Yeah,
I mean, I support the underlying approach they took, Becky, which is to reduce and to tailor more to each of the biggest banks the minimum enhanced supplementary leverage ratio. My concern with what they're doing is they're just doing it on one side. They're not, as I think they should, they're not applying market risk capital requirements to longer dated treasuries that are sitting in the available for sale portfolio. And as you know, even though we're going to continue to assume that those treasuries are entirely creditworthy, they can suffer losses in value as interest rates go up and markets move. And so it seems to me that while taking account of how much the federal government's debt burden has grown and how many more treasuries are out there, yes, we do need to make an adjustment in the ESLR. But I think we've still got to take into account the risks that really are there, and market risk is one of them.
Do you think the Fed will follow with those caveats, or they'll just go ahead and raise the limits?
Well, lower the minimum, which is raising how many treasuries can be held. No, I don't think they're going to follow my caveat. We'll see. I mean, they're into a comment period right now, and maybe people will make this point. But it's a broader trend, I think, Becky. I don't think we're seeing lots of hints of deregulation on the stress test, of course, on the Basel III endgame proposal, which won't be deregulatory, but I think it's not going to raise capital requirements. We're probably going to see it, although maybe not for a while, in reducing the GSIB surcharge. I haven't seen any indication yet of, even on a targeted basis, anything to respond to other issues that may be out there. For example, nothing still has been done to respond to the Silicon Valley Signature First Republic failures, notwithstanding the fact that 2 years ago, when we were all talking about this, we all identified a bunch of things that probably should be changed.